two Barclays analysts. One hot topic, all sides explored. This is The Flip Side. The Flip Side is a podcast series featuring lively debate between two Barclays research analysts, taking opposing viewpoints on timely topics of importance to economies and businesses around the globe.
Welcome to The Flip Side. I'm Jeff Meli, head of research at Barclays. Corporate bond and loan markets have traditionally been pretty rigid. Compared to equity markets, they've been characterized by low liquidity, low trading volumes, and higher transaction costs. But between the explosion of credit ETFs and the growth of private credit markets, all of that is changing. Today, my colleague Zornitsa Todorova and I are going to talk about whether active investors will benefit from a trend we call the equitification of credit. Zornitsa, thanks for joining me.
Excited to be here, Jeff.
I think the fact that credit markets are becoming more like equity markets is going to be good for active investors. They're going to be able to deploy a wider array of strategies to generate returns and outperform their benchmarks.
I disagree. I really think that this new trend is going to make life tougher and tougher for active managers. I believe that we're going to see market efficiency rise, volatility will drop, and then to me, the ultimate winner will be actually passive investing.
All right, let's get into it. One aspect of this equitification story that I referenced is that public credit markets are becoming significantly more liquid.
Yes, and historically, bond markets have been much less liquid compared to equities. And what I mean by that is that it costs much more to buy and sell bonds than it does to buy and sell stocks. And as a result, managing a bond portfolio is substantially more challenging.
Now, the constraint on corporate bond liquidity is linked to the large number of securities. Any given company has only one stock outstanding, but it could have many, many bonds outstanding. So let's use Apple as an example. The ticker AAPL, that's the stock. It's one of the most valuable companies in the world. Now, that same company has literally dozens. I think the actual count was 62 bonds outstanding.
That's right. And exactly because there is only one Apple stock, it's very easy to trade. At any point in time, there are lots of buyers and sellers, and computers can match their orders electronically. And so trading is really, really cheap. Even retail investors can get in on the act. They can open a brokerage account and trade stocks with little to no commission fees.
Now, it doesn't work with bonds and loans because it's a lot harder to match the buyers and sellers. Let's say, Zornitsa, you want to buy an Apple bond and I want to sell one. We have to get pretty lucky that we both pick the same bond if we're able to match off our orders, because it would just be 1 in 62 chance. That's why most bond trading isn't automated the way it is in equities. It's done by banks and other market makers in what's known as the over-the-counter or the OTC market. Market maker has to take positions into its inventory and then figure out over time who's going to take the other side of the trade. This makes the transactions much more expensive and also reduces the trading volumes. And that's what we mean when we say bonds are less liquid.
I agree, Jeff. But see, this is where we're observing this equitification in credit markets. And bond ETFs have really been at the core of that shift.
Yeah, now an ETF or an exchange-traded fund is similar to a mutual fund. It owns a diversified portfolio of assets, usually linked to some sort of benchmark or strategy. But the big difference is that ETF shares trade on exchanges, just like stocks, whereas mutual funds, of course, do not do that.
Yes, and the rise of that whole technological ecosystem that creates and trades ETFs really started the revolution in credit trading. Bond ETFs are incredibly liquid, and to your point, they're so liquid exactly because they trade actively on exchanges, just like stocks, so there's no difference. And so the first innovation in that process was that institutional bond investors who needed to manage daily liquidity, take, for example, mutual funds who get daily inflows and outflows. Well, they started to buy and sell ETFs instead of the bonds in order to manage this daily liquidity needs. And so the ETFs provide very similar exposures to the bonds they track. They're designed this way, so there's no surprise. But the advantage is that investors who use ETFs don't have to pay the high transaction costs of bonds. And you could see why this is particularly useful for mutual funds whose need to trade every day was really a drag on performance in the past.
Yeah, now more recently, investors have started to trade bespoke baskets of bonds. So not just the ETFs, but a bespoke basket that they create. And market makers can hedge and price these what we call portfolio trades using the ETFs. Again, that's possible precisely because ETFs are so liquid. They could be easily bought and sold. So they give real-time information about the price of portfolios of bonds. And these trends have made it much more easy to trade credit. The cost of portfolio trades, for example, are 40% or more below the cost of traditional trades. So this boosts credit liquidity, which is now a lot closer to what the liquidity is in the equity market.
What I think is most interesting about this new protocol is that it really turns the historical weakness of credit that you just talked about into a strength. Bond investors typically own vast number of bonds, and while it may be very hard to trade any bond individually, it's relatively easier to construct portfolios that can be then priced and hedged using ETFs. So one way to think about portfolio trading is like credit investing or credit trading, but with equity principles.
Yeah, I agree. And that same flexibility is also why I think active managers are the ones who are going to benefit from this trend. So first, let's think of the typical fundamentally driven investment style that's used in the corporate bond market.
Well, yes. So investors would typically analyze individual companies, and then they would pick a list of those that they think are going to perform better in the future and will be better able to pay off their debts.
Yeah, that's right. So as the cost of trading goes down, it becomes easier to take advantage of these opportunities because you're not paying away so much of the upside in the transaction costs.
I'm not so sure it's that simple in the end, because an important source of these opportunities is really forced selling. For example, when one investor needs to sell, say they need to raise cash because they have a big outflow today. And in the past, what they would need to do is pick up some bonds to sell. And that could cause the price of those bonds to drop, which then creates an opportunity for other investors to step in.
Sure, and the price impact of that selling can be large exactly because of the matching problem that we talked about.
Right. But now that same investor doesn't need to pick a few bonds to sell. They have other options. They can sell ETFs or they could do a portfolio trade. And so there's not really the chance for other investors to pick up cheap asset. And that makes it harder to generate returns. And to my point earlier, I think it makes the job of active managers really more difficult.
Okay, I think that's an interesting point. But at the same time, these new liquidity management tools have also expanded the investing styles and strategies that are available to credit investors. So let's take as an example factor and systematic investing. These are automated strategies that were limited to equities for a long time, but we're starting to see them pick up momentum in credit.
Okay, that's true. So these new strategies use quantitative models of bonds. So they're looking for signals of which bonds will outperform. And the source of signals really varies quite widely. Some, like value or growth strategies, are based on analyzing the characteristics of companies. But others might look for hints in more unconventional data sources. For example, they could use machine learning or artificial intelligence tools to dissect earning calls or go over press conferences or even analyze satellite images. But as you say, some of these strategies are really old hat in equities.
Now, I'd imagine that if I'm right, that we're starting to see an expansion of this strategy into the corporate bond market. We should have seen an increase in the demand for data-related jobs in credit.
Yeah, that's right. Data science jobs were not really a thing 10 years ago, but today about 10% of all the new job postings are looking for quants or data engineers or data scientists.
That's right. So I'm not surprised that the focus from finance jobs is really shifting into this sort of quant world. But these new quantitative strategies require you to be able to trade a lot of securities, like hundreds or even thousands of securities. The trades are in small sizes and they're meant to generate small returns from each trade. That's how these kind of systematic strategies work. If you ask me, that sounds like a perfect fit for portfolio trading. Investors can execute the strategy quickly, now using portfolio trades very efficiently. Before portfolio trades, they couldn't do this because the transactions are too expensive.
I agree. And we have, in fact, seen the first of these strategies being implemented, particularly in the corporate bond market. But how does that address the lack of volatility? That's still a question that I have.
Well, I think, first of all, it's a new way to generate returns. And so you could make up for some of the lack of volatility by supplementing your returns with these kinds of strategies. And I think these strategies will feature in an increasing number of portfolios, even those that aren't officially quote unquote quant in their focus. But the other aspect is that with more styles, there's more chances that investors are taking offsetting views. So imagine a bond looks really good to quant funds. They buy it, they push up the price. Then a fundamental investor looks at it and thinks, wow, that price is too high. I can sell and take advantage of that. Or vice versa, if the quant fund is selling, the fundamental investor might be able to buy something cheap. So when not all investors are looking at the world through the same lens, it creates more opportunities for these investors to find bonds that look attractive to them.
Well, I have a different perspective here, actually, and that's where the other aspect of the equitification story comes in, the rapid development of the private credit market.
Yeah, private credit is definitely all of the rage, and the market has grown significantly over the past several years. There's a lot of estimates of its size, and it depends how you calculate and add things up. But I think it's fair to say that between the US and Europe, it's now over something like $1 trillion. Of course, equities have long featured both a large and liquid public market and a very robust private market.
That's true. And both companies and investors have used public and private markets, but they've done so for different purposes. So a lot would depend on the maturity of the company. For example, are we talking about a startup or a more mature, a larger company? For investors, on the other hand, their preference would depend on their style and their holding period. But the point is that access to the two types of markets provides significant flexibility for everybody. Everybody is better off.
Yeah, now we're starting to see the same development in credit. So 10 years ago, the private credit market was limited to small companies, but it's now becoming a viable alternative to the public market for really all but the largest issuers, which is kind of similar to the situation in equities.
All right, so I think that so far we agree that this development is unambiguously good for issuers. Today, companies simply have more options when they need to raise funds. For example, some issuers might prefer the limited disclosures of the private market. Others might use the depth or the liquidity of public markets, or they can even do a combination of the two, like switching back and forth seamlessly between the public and the private market, depending on pricing or depending on their specific needs or the situation that they're in. But the story for investors is a bit more complicated than that. And it is because there is an important link between the two aspects of the equitification story. The growth in private credit is linked to the increased liquidity of the public market. And that's because that improved liquidity actually has a direct effect on the liquidity risk premium.
Yeah, now generally speaking, an asset that is illiquid will have a higher return associated with it. And that's because investors have to be compensated for taking the risk that the asset can't be bought and sold cheaply. That complicates managing a portfolio of those assets. That's historically been actually an important source of returns in credit. Bonds were hard to trade, and if you were forced to trade, your performance could suffer. So you insisted on higher yields.
Yes, and our recent research shows that the liquidity risk premium has declined by up to 50%. That's quite a lot. And that's exactly because it's so much easier to trade illiquid assets today. And it makes total sense. If it's easier to trade, why should you get the same premium? But of course, there are lots of investors out there who don't trade that much.
Yeah, sure. Pension funds, insurance companies, endowments, they don't need to trade that much because they don't manage daily inflows and outflows like a mutual fund or a hedge fund would.
Exactly. And that has allowed them to free ride on the liquidity premium. It was like free money for them. But now that has changed. The premium is lower and they don't find public credit as attractive anymore. So instead, they turn to private credit where they can possibly still capture part of that premium.
Yeah, and that's similar, again, to what we're seeing in equities. If you need to trade a lot or use a high turnover strategy like that quant investing or systematic investing that we talked about, you go to the public market. If you have a really long investing horizon, you look for opportunities in the private market.
But doesn't this imply that the returns in the public market are lower today? In other words, active managers can trade more easily. That I agree with 100%. But then their returns also fell in step with that improvement. So they aren't really better off, are they?
Well, look, I think one thing to consider is that the goal of an active manager isn't necessarily just total returns. It's really returns relative to their benchmark. They're trying to beat whatever their benchmark is. Beating the benchmark gets easier when trading gets easier. Sure, the total returns might be lower, say from the standpoint of a pension fund. But for a mutual fund, if it can beat the index, it attracts assets.
Well, it's interesting that the trend in equities has actually been the other way. The assets in passive strategies, which charge much lower fees simply for matching the performance of a benchmark, have grown, and active managers, on the other hand, have a lower share. And this is happening despite all the liquidity, which is kind of surprising at first glance. But then when I think about it, I think the story there is that markets have become more efficient as liquidity increased.
Yeah, now efficient markets to a layperson means something different often than it does to a finance person. To a finance person, it means not so much that the markets function smoothly, but rather that the prices are close to fair value based on all of the information that's out there available to investors.
I agree. And look at all the quant and factor investing and also how much easier fundamental trading has become. These new tools mean that investors are better able to take advantage of any deviation from fair value and that they are able to do this really quickly. So with a greater ability to exploit discrepancies, it could be the case that there aren't just many opportunities left. So sometimes you have to be careful what you wish for. But on the flip side, an illiquid asset class such as credit can offer fertile hunting ground, so to speak.
Well, sure, in principle, but when it's harder and more expensive to take advantage of those opportunities, it's harder to translate them into returns. But we'll have to see how these trends play out. It's still early days in the equitification of credit. It's a trend that's going to gather steam over the coming years.
Yes, agreed. And our team are really watching this trend closely and we'll keep clients updated.
Well, thanks for joining me, Zornitsa. You can find a link to our research on this topic in the show notes below. And clients of Barclays can get a more in-depth view of this and other forces shaping fixed income markets by accessing the 2024 Equity Gilt Study on Barclays Live.
That's all for now from this Barclays podcast. Thanks for listening, and we'll catch you next time on the flip side. For more insights about this topic, clients can log into Barclays Live or find out more at barclays.com/IB.